Welcome, you're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is the show where we focus on how to make mutual funds work for you. Now, we have a very interesting topic today. I'm speaking with Udayan Adhe. And Udayan, I must admit that I thought of calling you on the show after seeing a post that you put out, where you talked about 3 kinds of mutual funds to avoid. And I thought that's something, we should share and discuss with our viewers as well, because we are constantly hearing and talking about mutual funds that you should be buying and, where you should be investing, but what should you avoid? So let's start with you setting the context of what are these 3 kinds of funds, and then we'll go into detail for each one of them.
Absolutely, Tamanna. Good afternoon to you. Glad to be here. And, like you said, right, everyone keeps talking about, everyone has that question, which is the best mutual fund to buy? What should we buy? I'm sure you get that question also almost every day. When you're talking to a friend at a family dinner, that's the question. And while we have to understand the motivation of this question, right? Where can we get the highest return? That's what people actually want to know. There's no way to know that. We all know we can't predict the future. But in the pursuit of trying to get the highest return is when people make mistakes. And that is why I had put up that video where I spoke about the 3 types of mutual funds that they should almost always avoid. And the 3 of these mutual funds are, first up, a sectoral fund or a thematic fund. Because with sectoral thematic funds, we'll get into the specifics of it, but the risk thus becomes too concentrated. The second type of mutual fund that you should definitely try to avoid, again, in almost every single case, is NFOs or new fund offers. So these are new mutual fund schemes that are floated by asset management companies. And we have seen a lot of NFOs suddenly flocking the market. And the third kind of mutual fund that, again, you should avoid is a credit risk fund. So the first 2 funds are equity-oriented funds or funds that typically invest in stocks. NFOs can also be debt funds, but most of the new NFOs coming in are equity-oriented funds, whereas a credit risk fund invests in bonds, risky bonds. It has risk in its name, and we'll get into why as well you should avoid it.
Yeah, okay. So the 3 kinds of funds that Udayan says we should avoid. Now, when you say avoid, is this without exception, or there are specific, sort of parameters to think about? And I'm asking this because we're drowning in NFOs right now. There is a new fund on offer pretty much every day. And it's a bit of a blanket statement saying to avoid anything new or any new fund offer altogether, isn't it?
It is. And I would say avoid about 90-95% of the NFOs out there. And I'll also share a filtering mechanics with you as to which new fund offer could be a good idea to subscribe to buy. So first up, why am I even saying you should avoid NFOs? That's because when a new fund offer is floated, we don't have any track record whatsoever. We don't know how that fund manager has performed in that particular category, that particular sector. There's no track record. And on the other hand, there is almost always something available in the market, in the mutual fund universe, that you can buy instead of the NFO that has a 3, 4, 5, even 10+ year track record at times. So purely because of that, why venture into unknown territory? And more than, sharing all these qualitative things, let me give you some data. So 6 out of 10 NFOs have underperformed. And these are NFOs that I'm talking about since 2019 January. So 6 out of 10 NFOs have underperformed the benchmark or Nifty 500. That's number 1. And number 2, only 26% of NFOs, so that's 1/4 of NFOs that have been floated, stay in the top 25% of their category, which is once again eye-opening, right? Because people flock to these NFOs. Going back to the first question, you want higher returns. So you think that NFO is your avenue to get the high returns. But if the last 5-year data suggests that that is not true, then why are we flocking towards it? When there is something better available on the other hand that has a proven track record.
So, my question, just to counter on that NFO question, Udayan, is that in that sense, every fund which has a good track record right now was an NFO at some point?
Absolutely.
Yeah. So then that seems a little unfair, because then you don't allow any new product into the market to really thrive. What happens to innovation? So just playing devil's advocate here. I mean, how do you know you're not missing out on a great opportunity because you've just said, okay, I'll go with what is already there?
Great question, because that is usually what people come up to me with as a counter. Or the thing is, though, look, all of us have limited capital to invest at the end of the day, right? Let's say someone is doing a 10,000 per month SIP or is investing 10 lakhs in the market as a lump sum. That is the limited capital they have. So now they have to be prudent as to how they allocate that capital. Now, in a situation where, let's say, a new fund offer, an NFO, has been floated, which invests in a particular kind of a fund. So let's say it invests in blue chip funds or it invests in manufacturing funds. Now, in this case, I am almost always certain that there is a fund that has been a blue chip fund or a manufacturing fund that has been floated in the past. So you just have more data to work with, and the odds of making a mistake then kind of reduce. Again, there have been NFOs. I will counter my own point and say like HDFC Defense Fund, right? That is an NFO. That's a relatively newer fund that has done exceedingly well. 100+% returns in the past 1 year. It's the talk of the town. If you subscribe to this philosophy of not investing in NFOs, then you wouldn't have invested in that. But at the same time, to be realistic, how much money are you actually going to invest in an NFO of the overall portfolio that you are investing in? And at the same time, could there also be a defense fund before that that potentially also would have given you good returns? So the idea is to try to minimize risks. And I think with a framework like this, just invest in a parallel, similar kind of a fund instead of a completely new offering from a fund house.
So NFOs, really think about it before you get into them. That's point number one from Udayan. Let's come to the second point, which is sectoral funds. Now, sectoral funds, they have made people money. It's not like they haven't. And again, it's a big part of the new fund launches we're seeing are in fact thematic and sectoral funds. What is the downside according to you?
So with sectoral funds, right, I'll say, when I say never invest in sectoral funds, it comes with a small asterisk. And that asterisk would be, do not invest more than 10, 15, or if you're very, very bullish on something, if you've done your research, then more than 20% of your money in one particular sector. And there's a very straightforward rationale for it. If you put all your money in one particular category or one particular sector, then if that sector does well, you're going to be the happiest person because your money has multiplied several times in a few years. But there's also a chance that that sector may not do well. And we have seen that, right? Every now and then, there are sectors that have done well for 3-4 years. For the next 3-4 years, they don't tend to do well. The classic, when we talk about thematic funds, the classic example is value style of investing. So over the past 4 years, value style of investing in India has generated the most amount of returns for 4 consecutive years. But guess what happened 3 years before that, from 2018 to 2020? Value style of investing was the worst performing style of investing. So once again, if you really want to invest in a sector, keep your exposure to a sectoral fund to 10 or 20% of your portfolio. And while you're doing that, also make sure that the other money that you're investing is not investing in that same sector. Because let's say you're investing in a manufacturing sector, sectoral fund, and the rest 80% of your money, let's say, is split over 2 or 3 mutual fund schemes. Now, even if in those 2 or 3 different mutual fund schemes, you are investing a large part of that money in manufacturing, in the manufacturing sector, could be any sector for that matter. And if you're also investing in a sectoral fund, then again, you're having too much exposure to one sector. And if it doesn't do well, you're again going to potentially lose out money, or opportunity cost is going to be significantly high.
Udayan, let me come to the third one, which you talked about, credit funds. Now, explain in some detail what kind of funds these are and how popular they are, and why you are a bit, I would say, not so bullish on this.
So credit risk funds, to put it simply, let's say, Tamanna, I want some money. I know you. So I come to you and say, Tamanna, I need 10,000 rupees. Why don't you give it to me? Now, when I say that, you will analyze whether I have the ability to pay that money back to you. Now, this also happens with very large institutions, large banks, or when we take loans, right? The bank analyzes whether we can pay that loan back. So as per the financial system, there is a mechanism to rate how likely is a borrower, how likely they are to repay the loan. And based on that, then they get rated a particular grade. Now, with credit risk funds, you get amongst the lowest grades in the fund. So the bonds that have the lowest grade, the borrowers that have the amongst the lowest grades, they form a part of that bond fund. So let's say tomorrow you go to the government of India, which has a sovereign rating. There, that's the highest rating along with AAA that you can get. But what if the rating is triple C or triple B or BB plus? It gets into too much of the nitty gritties of it when I mention all these ratings. But in credit risk funds, you are potentially investing in bonds where the likelihood of you getting that money back is significantly lower than something that is highest rated. So once again, right, the idea behind all these three mutual fund types or mutual fund categories that you should avoid, the idea is very simple. Because I believe investing is a loser's game. That means if you make mistakes, you're going to end up not really getting a satisfactory result. You don't have to hit a big winner. You don't have to hit a Virat Kohli like cover drive. That's a winner's game. Cricket, tennis, those are winners' games. You have to be skilled enough to be able to actually come out triumphant. But in investing, if you try to avoid mistakes, and we won't eliminate each and every mistake, but if you avoid mistakes, do as much as you can, then anyway you're going to end up winning. And once again, with credit risk funds, if the ability for that fund to pay you back is lower, then why invest in that? And why invest in that for 1 or 2 extra %? Because just to give you an idea, if you had invested 1 lakh rupees and that grows at about 7% for 10 years, you have about 1.952 lakhs. If it grows at 8%, 1% higher, you have about 20,000 extra, 15, 20,000 extra. So for that, why do you want to take on that additional risk where you may not even get that 1 lakh back that you've invested?
Okay, so we've talked about what funds you should not look at, but then let me ask you the question in reverse, Udayan. What are the parameters to pick funds now? And maybe one of them is that a fund that has a great track record, that's not information that everyone knows how to access.
Absolutely, absolutely. So the kind of metrics that you would look at is, so one more reason, by the way, Tamanna, sectoral funds or thematic funds have become so popular is because almost every single mutual fund investing platform and website now allows you to filter returns as per performance. So what most people do is they click on that filter that allows them to see which is the best performing fund in the past 1 year, in the past 6 months. And invariably, there are certain sectors that have done exceedingly well. So they start investing in that. Now, instead of looking at 1 year returns or just blocked returns, trailing returns, it's essentially to look at something called as rolling returns. What do you mean by rolling returns? Let's say now you're looking at 5-year trailing returns from today. So that is about 28th August 2020, 27th August 2024. So you look back at the returns that the past 5 years have generated, which will give you the returns from one point to the other. But rolling returns, they look at all the data points. Let's say looking at rolling returns from 2010. Now in that case, they look at 5-year blocks, all the 5-year blocks that have been in existence from 2010 to 2024. So you look at 1st January 2010 to 1st January 2015, 2nd January 2010 to 2nd January 2015. What this allows you to do is it tells you whether a fund has been a consistent performer, because there have been funds that perform well at certain times and not well at other times. But with rolling returns, that kind of gets evened out and you get a better analysis of what kind of returns that you get. So that's number one. Number two is the capture ratio. So this means if, let's say you're investing in blue chip companies, the India's largest companies, large cap companies, you would want to look at when your fund has gone up 10% and the index has also gone up 10%, then has your fund captured the entire 10% move? So ideally, if the index or the corresponding benchmark goes up by a certain amount, you want your fund to perform a little better. But more importantly, when it starts going down, let's say in 1 year, the Nifty 50 is down 20%. You want your large cap oriented fund to not fall 20%. You want it to fall a little lower. So ideally, the capture ratio should be about 1. If it's about 1.5, that is great. And all these numbers that I'm talking about, all these metrics that I'm talking about, they are one Google search away. So if you just literally search for calculate capture ratio of mutual fund, you will see 3-4 websites there that will do it for you for free. So that is the second. And the third is purely in terms of overlap or portfolio construction. So if you're investing money for say 2 years, 1 year, investing it in a small cap fund, a mid cap fund, or an all equity fund is not a good idea, because again, in 2 years, your fund may do exceedingly well if markets do well, but there's a chance in the short run in the equity market that you may end up with a slightly lower or even negative return. So aligned with your goals and risk profile would be the third point that you would want to consider.
Okay. All right. So a lot of basics there put out very clearly by Udin. Let's take this opportunity to get some of your queries, those numbers on your screen, and you can always write into us and get our experts to answer your questions on mutual fund investments. First question today comes in from Ram, aged 31, says, I'm planning a 20,000 rupee SIP for 20 years and I'm invested in the following funds. Should I rebalance? So he's given his details of funds as well. UTI Next 50, 3,000 rupees, Nippon India Large Cap, 5,000 rupees, HDFC Mid Cap is also there, 3,000 rupees. Motilal Oswal Mid Cap, Quant Small Cap, Bandhan Small Cap. So a mix of largely small and mid cap in a quant fund as well. Udin, if you look at this portfolio, what would be your advice? Is it time to rebalance?
Whether to rebalance kind of depends on two things. So firstly, how long you have been investing, because this person now has invested in the three main categories, right? Large cap, mid cap, small cap. So they're kind of well diversified. So Ram has structured his portfolio well in that way. Now you want to consider how long you have been investing for, because if you've just been investing for 6 months or 1 year or even 18 months, it may not make too much sense to rebalance, because you want to allow these funds to run up or run down depending on how the markets are doing. So rebalancing ideally should be considered every 2 to 4 years, not before that, because think about it, right? Every time you rebalance, you have to sell something. That's a taxable event. So depending on the amounts, you may have to pay a large amount of tax. When you pay tax, that eats into your gains. So you have to be careful of that. And the second factor that again should be considered is whether you want to rebalance at all. Because at times, like in the past 3-4 years, people who have been investing in mid and small caps, they have seen returns of 100, 150, even 200% at times in their mutual fund schemes. So what tends to happen is when, let's say, you've gotten a 100% return, your money has doubled in a particular mutual fund scheme, and as it so happens, there will come a time when the markets are not doing as well. So now the 100% return has fallen to 70%. If that makes you feel bad and really anxious, because it's the loss aversion philosophy, right? Like we are more likely to feel the pain of losing something than gaining something. So if you think you have lost out on returns, and that stops you from investing or reduces your investing ability, or that triggers a panic sell, then in that case, it's a good thing to rebalance, because it just helps you stay invested. Because every now and then, every 2 to 4 years, you're taking some profit, reinvesting it back into either a safer asset like a bond, or within the other funds that you have that haven't done as well. So if that is something that is going to make you feel comfortable, then go ahead with it. But only think about it at least after 2 years, if not 3 and 4 years. So you let the portfolio run, let the different categories do what their job is.
Okay. Thank you so much, Udin, for joining us today and giving us your perspective on what funds not to invest in, what to look for while investing in funds, and also answering some of our viewers' queries. Udin there with his advice, and thank you for speaking to us.